In 12 months, the US government needs to refinance $9 trillion in debt, not borrow. Refinance, rollover obligations that were issued at 1.6% into a world where rates are at 4.5%. For the first time since World War II, America is spending more on interest payments than on its entire military. And the accounting convention that's been hiding that fact from public view has a name and a historical precedent. September 28, 1976, British Chancellor Denis Healey is at Heathrow Airport, bags packed, boarding a plane, when his phone rings. The pound is collapsing. He turns around. And 3 weeks later, Britain begs the IMF for the largest emergency loan in the fund's entire history. The numbers the US is running right now are worse than Britain's were that day. This video will show you the exact mechanism, the historical parallel, and why Bitcoin, not gold, not real estate, is the only mathematically coherent response to what's coming. Let's start with what everyone already knows, or thinks they know. The United States has $38.6 trillion in national debt. That number has been on every financial news channel, every op-ed, and every presidential debate for the last decade. It has been so repeated that it has lost its meaning. It has become background noise. The market keeps functioning. Treasuries keep getting bought. The dollar remains the world's reserve currency. Auctions clear. The government pays its bills. So the conventional wisdom, especially on Wall Street and in mainstream economics, is that while the debt is large, it is manageable. The US has never defaulted. It has the deepest capital markets in human history. Global demand for dollar-denominated assets is structurally resilient. Foreign governments hold $8.5 trillion in US treasuries. Japan alone holds $1.1 trillion. Even as China has reduced its holdings from a peak of $1.3 trillion down to $730 billion, the market has absorbed the difference. The story goes, yes, the debt is big, but the US is a going concern. It always has been. It always will be. And here's the first thing I need to break down for you. Because that phrase, going concern, is doing more work than most people realize. In private sector accounting under GAAP, generally accepted accounting principles, a going concern assumption is something auditors can revoke. When a company has substantial doubt about its ability to continue as a going concern, auditors are legally required to flag it. That warning triggers SEC disclosures, potential credit downgrades, and bankruptcy proceedings. There are precise quantitative thresholds that trigger a going concern warning. Liquidity ratios, debt-to-asset ratios, interest coverage ratios, meaning how many times over does your operating income cover your interest payments. Here is the US government's interest coverage ratio right now. In fiscal year 2024, the federal government paid $882 billion in net interest on its debt. Federal revenues were approximately $4.9 trillion. That is an interest-to-revenue ratio of roughly 18%. In FY 2025, interest costs rose again to an estimated $970 billion according to the American Action Forum. The CBO project's net interest costs will exceed $1 trillion in 2026. In the private sector, if you are spending 18 cents of every dollar of revenue just on interest payments, and that number is rising every year, your auditor flags you. Your creditors restructure. Your CFO gets replaced. The US government faces none of those mechanisms. Because sovereign governments do not get audited by independent parties. They do not face going concern warnings. They do not have creditors who can accelerate maturities. They operate under what you could call sovereign going concern accounting, the perpetual assumption that the state will always exist, always tax, and always borrow. It is not fraud. It is a convention. But it is a convention that allows the most dangerous kind of financial deterioration to occur invisibly, gradually then suddenly, until the moment the market decides the convention no longer holds. And then you get Denis Healey turning around at Heathrow. Before we look at why the bond market is starting to strike, I want to see who is awake with me today. The accounting illusion is global, but the resistance is happening in real time all over the world. I want to see our footprint. Drop a comment right now. Tell me your city, the exact local time, and the weather outside your window. Is it a cold morning in London, a humid night in Singapore, or are the lights still on in Miami, Austin, or New York? Let me know. And if you believe that access to this level of financial truth should be a right, not a privilege, hit the like button and subscribe right now. It's the only way we signal to the algorithm that we want signal, not the mainstream noise. Now, let's look at the arithmetic, because in 2025, the numbers stop being theoretical. I want to be precise here. I'm not saying the United States is about to default. I'm not saying bond markets are about to seize. What I am saying is that the accounting framework we use to evaluate US solvency is categorically different from the one we would apply to any private entity. And that difference creates a false sense of security that has real consequences for how ordinary people position their assets. Here is where it gets concrete. In 2025, $9.2 trillion in US Treasury debt matured and required refinancing. That figure comes directly from Deloitte's September 2025 Economics Insider. Roughly 1/3 of all marketable U.S. debt, representing nearly 30% of GDP, had to be rolled over in a single 12-month window. Let me put that in context. The last time gross Treasury issuance approached this scale was during the COVID emergency in 2020. But that debt was issued at near zero interest rates. The Federal Reserve's balance sheet tripled. The government borrowed at an average effective rate of around 1.6%. The debt maturing in 2025 and 2026 is not being refinanced at 1.6%. It is being refinanced at 4.3 to 5.5%, depending on the maturity. That is not a subtle shift. That is a complete reset of the cost structure. According to the Bipartisan Policy Center, the average interest rate on all outstanding U.S. debt was 1.61% in 2021. By August 2024, it had doubled to 3.3%, the highest since 2009. And that average is still moving up. Every new issuance is at current market rates, not the near zero rates of the pandemic era. The PGPF, Peter G. Peterson Foundation, put it plainly, more than $3.1 trillion of the debt rolling over in this cycle was last issued 2 or more years ago. It was almost certainly issued at rates significantly below current levels. That $3.1 trillion alone represents a material repricing of the government's cost of capital. Add to this the FY 2025 deficit of $1.9 trillion. The government needed to borrow an additional $1.9 trillion on top of the $9.2 trillion rollover. Total gross Treasury issuance for the year, above $11 trillion. According to First National Financial, this is a volume no modern market has absorbed before, and 55 to 60% of it came due in the first half of the year. It was front-loaded, concentrated, and pressure testing the capacity of global bond markets. Now here is the number that should make you stop. In fiscal year 2024, for the first time in the history of the United States, going back to at least 1940, the federal government spent more money on interest payments than on national defense. $882 billion in interest, $874 billion in defense. The Committee for a Responsible Federal Budget confirmed this. The Congressional Budget Office confirmed this. The Council on Foreign Relations confirmed this. Interest payments exceeded the entire Pentagon budget for the first time since World War II. And in FY 2025, the American Action Forum estimated interest costs reached $970 billion, while defense spending was $917 billion. The gap widened. The CBO project's interest payments will hit $1 trillion in 2026 and then continue rising. By 2050, the CBO's own projections show interest payments becoming twice as large as defense spending. This is why historian Niall Ferguson's work deserves attention here. Ferguson published a formal paper through the Hoover Institution at Stanford in February 2025, introducing what he called Ferguson's Law. The proposition is that any great power that spends more on debt service than on defense risks ceasing to be a great power. He traced this pattern across Habsburg Spain, pre-revolutionary France, the Ottoman Empire, and the British Empire. His precise language, any great power that spends more on debt service than on defense will not stay great for very long. He published that warning. The United States crossed the Ferguson limit in 2024. Habsburg Spain crossed it in the 1590s. France crossed it before 1789. The Ottomans crossed it before the empire dissolved. Britain crossed it after World War I. And the following decades saw the systematic dismantling of the British Empire. That is the historical pattern. And that is the complication. Let me return to Britain in 1976, because this isn't just an interesting historical footnote. It is the closest structural parallel we have to the United States today, and the specifics matter. By 1976, Britain was running a fiscal deficit of approximately 10% of GDP. Its public sector borrowing requirement was expected to reach £10.5 billion for the fiscal year. Inflation had peaked at 27% in 1975, driven by the oil shock. This was fueled by public sector wage settlements and money supply expansion used to defer hard choices. Sterling had fallen from $2.40 to the pound in 1973 to $2 by early 1976, then faster. By June 1976, it had reached a record low. By the time Chancellor Healey turned around at Heathrow on September 28th, the pound was at $1.65. The sequence had begun not with a dramatic crisis, but with a quiet buyer's strike. Domestic institutional investors, pension funds, and insurance companies stopped buying British government bonds. They were not confident that rates had peaked or that inflation was contained, so they simply stepped back. As OMF documented, by autumn 1976, there was a buyer's strike among the usual domestic institutional investors in government debt. The IMF loan, $3.9 billion, was not primarily about cash. It was about signal. It was about restoring the credibility the market had already withdrawn from the UK. The conditions were severe: £2.5 billion in public spending cuts, roughly 2% of GDP. Higher interest rates and monetary tightening were mandated. In exchange for those commitments, the bond market finally stabilized. The lesson: the crisis was not a sudden collapse, but a slow-motion credibility erosion. The solution was not prosperity, it was austerity imposed by an external creditor. Now compare 1976 Britain to 2026 America. Britain's fiscal deficit, 10% of GDP. US deficit in FY 2025, 6.4%, lower, but with a much larger absolute debt stock and significantly larger rollover requirements. Britain's debt-to-GDP ratio in 1976 was high, but not at historic extremes. US debt to GDP is now at 101%. This is above World War II levels as a peacetime ratio, and projected to reach 118% by 2035. Britain's interest costs were severe, but their total debt rollover requirements were not $9.2 trillion in a single year. The US has one tool Britain did not have: reserve currency status. The dollar is not just the US's currency, it is the world's. Approximately 59% of global foreign exchange reserves are held in dollars. Global commodity markets, oil, gold, and grain, are priced in dollars. This provides a structural buffer against the kind of acute strike that hit gilts in 1976. But, and this is critical, that buffer is not unlimited, and it is not being renewed. China's treasury holdings fell from $1.3 trillion in 2013 to $730 billion in July 2025. Japan, the largest foreign holder at $1.11 trillion, has been a net seller lately to defend the yen. Foreign ownership of U.S. treasuries fell from 43% in 2012 to 29% in 2024. The buyers' strike in 1976 happened over months. If the U.S. experiences a gradual repricing of risk, the math on a $9 trillion annual refinancing becomes materially more difficult. That is not a prediction. That is a structural vulnerability. And the fact that sovereign accounting convention obscures it does not make it less real. So we've established the situation. The U.S. is running metrics that would trigger going concern warnings. These would be mandatory if applied by private sector auditors under GAAP. We've established the complication: $9 trillion plus rolling over annually at doubled interest rates. Interest costs are exceeding defense for the first time since World War II, violating Ferguson's law. We've established the historical parallel: 1976 Britain, a buyer's strike, an IMF bailout, and systemic currency destruction. The question is, given the accounting illusion and the refinancing pressure, what is the rational response? What is the actual portfolio strategy for this specific historical moment? And specifically, why is Bitcoin the structural hedge that this moment calls for? Why rather than gold, rather than real estate, or rather than foreign equities? This is where I want to be precise, because the Bitcoin argument in this context is unique. It is not the number go up narrative you typically hear in the media. It is not just about institutional adoption or ETF inflows. It is a specific accounting and monetary argument that almost nobody has made clearly. Every liquidity event in modern history has benefited Bitcoin. Here's why that isn't coincidence. Let's talk about the historical evidence first, and then I'll explain the mechanism. 2009, QE1 and Bitcoin's Genesis Bitcoin launched in January 2009, directly in the aftermath of the global financial crisis. Satoshi Nakamoto embedded a reference to a bank bailout headline in Bitcoin's Genesis block: Chancellor on brink of second bailout for banks. This wasn't decoration, it was a mission statement. The Fed's first quantitative easing program began in November 2008. $600 billion in mortgage-backed security purchases. This was followed by $300 billion in treasury purchases. By June 2011, the Fed's treasury holdings had more than tripled. During that same period, Bitcoin went from effectively zero to $26.90, its first major price event. 2012 to 2013, Cyprus banking crisis. In March 2013, the Cypriot government, facing a banking collapse, proposed a bail-in. This was a haircut on bank deposits above 100,000 euros. For the first time, Western depositors watched a Eurozone government reach directly into bank accounts to fund a sovereign rescue. Bitcoin surged from approximately $30 to over $260 in April 2013. This was a roughly 800% move in weeks. Research in the Journal of Risk and Financial Management found that Bitcoin's price surged specifically during the European sovereign debt crisis. 2020, COVID QE, $4.8 trillion. The COVID fiscal and monetary response was historically unprecedented. Combined stimulus actions totaled 24.6% of debt to GDP. This was more than 3 times the response to the 2008 financial crisis. The Federal Reserve cut rates to zero on March 15, 2020, and announced a $700 billion QE program. Within days, it expanded that program to unlimited asset purchases. Bitcoin's price on March 12, 2020, $3,850. By December 31st, 2020, it reached $28,949. This represented a 651% recovery in 9 months. Michael Saylor made the mechanism explicit when he explained his $425 million purchase. The purchasing power of the cash is debasing rapidly, he said. It was an accounting response to debasement. 2022 to 2023, T-bill crisis and liquidity injection. Silicon Valley Bank, Signature Bank, and First Republic collapsed in rapid succession in early 2023. The Fed responded with the Bank Term Funding Program, a facility allowing banks to borrow against treasuries at face value. This was effectively a $300 billion plus liquidity injection. Bitcoin, trading near $20,000 in early March 2023, rallied through $30,000 by April. By late 2023, it hit $40,000, precisely correlated with the liquidity expansion. Swan Bitcoin's research documented this. Bitcoin's price seems to respond favorably to periods when the Fed performs QE. The pattern is not anecdote. It's consistent across 15 years in multiple distinct liquidity events. This isn't Bitcoin will go up. This is a structural accounting argument. Here's the mechanism. Here's why the $9 trillion refinancing event specifically is a Bitcoin catalyst. It is not just because money printer go brr, but because of the specific structure of the problem. When the U.S. government needs to roll over $9 trillion in debt at higher interest rates, it faces 3 possible paths. Not 2, 3. Path 1. Genuine fiscal consolidation. Cut spending dramatically, raise taxes, and reduce the deficit to restore market confidence. This is the fiscal equivalent of what the UK did in 1976. IMF imposed austerity. Politically, in the current U.S. environment, this path is essentially closed. The 2025 budget reconciliation process resulted in expanded deficit projections, not contracted ones. Congress extended the 2017 tax cuts, and defense spending increased. Path 2. Buyers strike and yield explosion. Foreign and domestic investors reduce demand for treasuries, and yields rise sharply to attract capital. The government's interest costs spike, creating a self-reinforcing feedback loop. Higher yields mean higher costs, which mean higher deficits and more supply. This is the nightmare scenario. It is not the base case, but the structural trends are moving in this direction. Falling foreign ownership and a shrinking Fed balance sheet are consistent with this gradual shift. Path 3. Financial repression and monetary accommodation. The Fed, under political pressure or systemic necessity, pivots back toward accommodation. This happens through rate cuts, renewed QE, or yield curve control. This is historically the most common response of reserve currency sovereigns facing unsustainable debt. The U.S. used financial repression extensively after World War II. They held interest rates below inflation for years to erode the real value of war debt. Reinhardt and Rogoff's landmark research documented approximately 320 sovereign external debt defaults since 1800. But that count understates the true frequency of sovereign debt resolution. The most common form is not default, it is inflation. This involves printing money, debasing the currency, and transferring wealth from savers to the government. Bitwise's institutional research team put it directly: Bitcoin's supply growth is just 0.9% per year. It is specifically positioned to benefit from both sovereign default scenarios and high inflation environments. The fixed supply doesn't just prevent debasement, it mathematically inverts the relationship between monetary expansion and purchasing power. Here is the accounting argument in its clearest form. Every dollar of QE, or financial repression, reduces the real purchasing power of dollar-denominated assets. Savings accounts, bonds, and money market funds are all eroded in real terms. This happens when the money supply expands faster than real economic output. Gold has historically served as the hedge against this dynamic. But gold has a supply that, while constrained, is not fixed. New mining adds roughly 1.5 to 2% annually to the above-ground stock, and gold cannot be transmitted digitally, self-custodied at scale, or programmed. Bitcoin's supply is fixed at 21 million. Not approximately 21 million, but exactly 21 million. This is enforced by code that cannot be overridden by a congressional vote or Fed committee decision. When MicroStrategy, now holding over 400,000 Bitcoin, describes it as a treasury reserve asset, they are being literal. They are applying standard corporate treasury logic. If your functional currency is being debased, you hold assets whose supply cannot be inflated. The $9 trillion refinancing does not guarantee QE. What it guarantees is that the fiscal pressure pushing toward monetary accommodation is now structural. The CBO project's deficit's averaging more than $2 trillion annually for the next decade. With $9 trillion plus rolling over every year, any meaningful rise in yields is mathematically catastrophic. The incentive structure for accommodation is overwhelming, and every major accommodation event in the last 15 years has produced a Bitcoin bull market. Let me tell you what the critics say and why they're partially right. I want to be fair here because intellectual honesty matters and because the Bitcoin as hedge argument has real weaknesses that you need to understand. Counter-argument 1. Bitcoin is a risk asset, not a safe haven. This is factually true in the short term. Bitcoin exhibits a positive correlation with tech stocks of approximately 0.52, according to Awanda's analysis. In liquidity crunches, actual deleveraging events, Bitcoin sells off alongside equities. March 2020 proved this. Bitcoin dropped nearly 40% before recovering. The 2022 crypto winter was driven partly by Fed tightening, not easing, and Bitcoin dropped more than 75%. The rebuttal. Well, the hedge argument for Bitcoin is medium to long term, not intraday. The pattern that matters is the 12-24-month response to major liquidity events. And across those timeframes, the correlation with monetary expansion is consistent and compelling. You need to be positioned before the liquidity event, not during it. Counterargument 2. The US will never default and reserve currency status makes this analysis overblown. This is a serious argument. The dollar's structural advantages are real. The network effects of dollar-denominated global trade, the depth of US capital markets, and the absence of a credible alternative reserve currency all provide genuine buffers. The rebuttal. The Bitcoin hedge doesn't require a US default. It doesn't even require a currency crisis. It requires only that the US continues on its current fiscal path, deficits averaging $2 trillion, debt servicing consuming an ever larger share of revenue, and that the political system continues to choose accommodation over austerity. That's not a controversial prediction. That's the CBO's baseline. Counterargument 3. Bitcoin is too volatile to function as a hedge. Legitimate concern. Bitcoin's daily standard deviation of around 2.1%, even having halved since 2021, is significantly higher than gold or treasuries. The rebuttal. The volatility is the price of asymmetric upside. A 75% drawdown followed by a return to all-time highs and beyond, which has happened in every major Bitcoin cycle, produces a long-term return profile that no traditional asset class has matched. The question isn't whether Bitcoin is volatile. It's whether the risk-adjusted return over a 3- and 5-year holding period justifies the allocation. For investors who understand the monetary mechanism and can stomach short-term volatility, the historical answer has been yes. Let me bring this full circle. September 28, 1976. Dennis Healy turns around at Heathrow. The pound is in freefall. Britain is about to beg the IMF for the largest loan in the fund's history. What did that moment teach us? It taught us that sovereign governments operate under an accounting convention. The permanent going concern assumption allows fiscal deterioration to proceed invisibly until it doesn't. It taught us that the breaking point isn't always a default. Sometimes it's a buyer's strike. Sometimes it's a currency crisis. Sometimes it's the simple, unbearable arithmetic of rolling over too much debt. The United States in 2026 has metrics that are worse than Britain in 1976 on several dimensions. $9.2 trillion rolled over in 2025. Another $9 trillion maturing in 2026, interest costs at $970 billion, above defense spending for the first time since World War II. Ferguson's Law violated. Deficit averaging $2 trillion. CBO projecting debt to GDP to reach 118% by 2035. The accounting convention says, going concern, always. The auditor, if there were one, would say substantial doubt. The difference between those two assessments is where Bitcoin lives. Not because Bitcoin solves the US debt problem, it doesn't. Not because Bitcoin replaces the dollar, it won't. But when the resolution to an unsustainable debt trajectory is monetary accommodation, more QE, financial repression, and inflation, then the asset with a fixed, irreducible supply of 21 million units is not a speculative bet. It is the only mathematically coherent response to a going concern assumption that the market is slowly beginning to question. In 2009, Satoshi put a newspaper headline in the Genesis block of Bitcoin, Chancellor on brink of second bailout for banks. It wasn't a coincidence, it was a diagnosis, and the patient hasn't recovered. $9 trillion, 12 months, one hedge. But before I go, I want to talk to you specifically. The average person watched less than 5 minutes of this video before clicking away for something easier. But you stayed for the whole investigation. You sat through the IMF history, the CBO data, and the gap accounting logic. Now, that means you're not just an investor, you're a researcher. You have the attention span that Wall Street and the central banks count on you not having. You are officially part of the 1% who actually knows what's happening behind the curtain. If you made it to this final second, I want you to leave a comment with these 4 words. I see the machine. I read every single one of those, because those are the people this channel was built for. Hit the like button and subscribe if you want me to keep going deeper on this. This story is far from over. Stay vigilant. I'll see you in the next one.